Welcome to the very first episode of The Disciplined Trader, where we dive deep into the world of trading with a focus on mastering not just the markets, but ourselves. I'm excited to have you here because today we're going to talk about something that many new traders, and even experienced ones, struggle with, but often overlook: the behavioral patterns that sabotage traders. Now, trading isn't just about charts, indicators, or news. It's not just about knowing when to buy or sell. Sure, those are important, but if you can't get a handle on your own mind, all the technical analysis in the world won't save you from mistakes. What we're talking about today are the subtle, sometimes hidden patterns of thinking and behavior that can quietly erode your performance and your account balance. Let's start with the idea of behavioral biases. In simple terms, a bias is a systematic deviation from rational decision-making. It's a shortcut your brain takes, sometimes helpful in everyday life, but in trading, these shortcuts can be disastrous. Over time, small biases add up. They can make you overconfident, emotionally reactive, and prone to repeating the same mistakes over and over. One of the most common pitfalls I see is overconfidence. Many traders, especially when they start seeing a few wins, believe they are invincible. They think, "I know what I'm doing. I've got the edge." And sure, confidence is important, but when overconfidence sets in, it clouds judgment. You might take positions without proper analysis, ignore risk limits, or dismiss warning signs because you believe you're always right. The markets have a funny way of humbling the overconfident, often painfully. Another trap is confirmation bias. This is when you only look for information that confirms what you already believe. Maybe you've convinced yourself a certain stock or currency pair is going to rally. And suddenly every news article you read or every chart pattern you notice only seems to back that up. You filter out anything that might suggest otherwise. The danger here is that your perspective becomes skewed. You're making decisions based on a filtered reality, not the actual market. Then there's loss aversion, which is incredibly common. Humans naturally fear losses more than they value equivalent gains. For a trader, this can mean holding on to losing positions, hoping for a turnaround that might never come, or exiting winners too early just to lock in a small profit. Both behaviors limit your potential and expose you to bigger risks. You also have anchoring, which is when you give too much weight to the first piece of information you receive, like a past price or historical high, and allow that to dictate your current decisions. Markets move, conditions change, and clinging to outdated reference points can prevent you from adapting to the now. Herd behavior is another pattern to watch. Following the crowd can feel safe, it's natural, right? But in trading, it's dangerous. Jumping into a trade just because everyone else is doing it often leads to exaggerated market swings and losses. The fear of missing out, FOMO, can push you to act impulsively, rather than strategically. Similarly, recency bias makes traders overweight recent events. A big win yesterday can make you think today will be just as profitable. A recent loss can make you overly cautious. Historical context and longer-term trends get ignored, and decisions become short-sighted. Emotional attachment leads to the endowment effect. If you own an asset, your brain inflates its value just because it's yours. This bias can make you hold on to positions far longer than you should. It's hard to sell something you feel belongs to you, even when the data says it's time to move on. We also have availability bias, which occurs when traders rely on information that's easy to access, like the latest headlines or a viral forum post, instead of doing deeper research. Quick, anecdotal info can mislead you, leading to misinformed trades. A classic one, particularly misunderstood, is the gambler's fallacy. Many traders think that after a string of losses, a win is due. Or after a streak of gains, a loss must come next. In reality, markets are largely independent events. Expecting patterns where none exist can encourage risky behavior and poor decision-making. And finally, self-attribution bias. This is when we take credit for successes but blame external factors for failures. It's flattering, but it's destructive. By failing to recognize what truly went wrong, you miss the chance to learn and improve. So, with all of these behavioral traps in mind, the next question is, what can we do about them? How do we avoid falling into these patterns? The first step is developing a trading plan. A well-defined plan gives structure to your decisions. It tells you when to enter and exit, how much risk to take, and how to measure performance. It becomes your anchor in a sea of emotions and noise. Then there's data-driven decision-making. Relying on objective analysis, rather than gut feeling or emotion, keeps biases in check. Always question your assumptions and let the market, not your emotions, dictate your actions. Emotional awareness is key. Check in with yourself before, during, and after trades. Are you stressed, euphoric, frustrated? Your emotional state affects your choices, so acknowledging it is the first step toward controlling it. Seeking diverse perspectives also helps. Talk with other traders, explore different viewpoints, and be open to feedback. It can highlight blind spots and reduce the risk of confirmation bias. Finally, regular review and reflection. Analyze your trades, not just the winners and losers, but why you made the decisions you did. Understanding your behavioral tendencies allows you to course-correct over time. Behavioral patterns may sabotage traders, but they don't have to define your journey. By understanding these biases, implementing strategies, and committing to self-awareness, you can improve decision-making, protect your capital, and build long-term success. In our next episode, we'll continue this exploration, looking at additional psychological pitfalls and practical strategies to further strengthen your trading mindset. Remember, trading is as much about mastering yourself as it is about mastering the markets. Keep learning, stay disciplined, and don't let your own behavior stand in the way of your success.
Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!